Hi everyone, my name is Corey Stackhouse and welcome to today's video where we're going to discuss whether it makes the most sense to look at an IRA, a Roth, or an HSA, or a combination of the three with regards to your retirement assets. So let's dive in. So first off, let's begin with IRAs and Roth IRAs. Now, for sake of simplicity, I've only put IRA and Roth on these buckets on my pictures that you see here. This is going to be applicable to 401ks and Roth 401ks, along with other employment-sponsored accounts as well. But for taxation's sake, let's begin there. So whenever you put money into an IRA, that money is going to give you a tax deduction. So for simplicity's sake, let's assume that a household, they make $100,000 collectively between husband and wife annually. Now, we're not talking about other standard deductions at this point. We're just talking about contributions into the IRA. So let's assume this couple decides that they're going to put $5,000 into the IRA towards their 2023 contributions. As of recording this video, it is calendar year 2023. That's why I'm using that calendar year. Now, if the couple puts in $5,000 into that account, their earned income for the year is going to be adjusted downward by $5,000. It is a tax deduction that they receive. So since they didn't pay money on the taxes whenever they put the money into that account, what do you think happens whenever it comes out? They're going to be taxed at their ordinary income rates whenever they decide to pull the money out. And for simplicity's sake, let's assume after the age of 59 and a half. A Roth is the opposite. So you're going to use after-tax money to put money into that account. Once that money comes out of that account, it comes out tax-free. Now, the biggest piece of this with the Roth is there are three different kinds of money inside of that account. So you've got your contributions. That's what you're adding to your account. So same situation, you've got a couple, they make $100,000 collectively. They go ahead and add $5,000 to their Roth IRA. That's after-tax money. They will not get a tax deduction on their income that calendar year. So the rules with contributions is, let's assume this couple's 55. There's no date that you have to leave that money in for your contributions. You can take that money out the next business day if you had something come up. That's a fun fact that a lot of people don't know about Roth IRAs is you could hypothetically put money into them and then take that money right back out the next business day if you want. Now, if that money had any earnings or gains on there, you will want to leave that in until 59 and a half to avoid any penalties on that money. So side note there. Now, the second type of money, since we skipped down to the third, the second type is going to be converted money. So if you have an old retirement account, let's say it's a 401k, and you wanted to convert that money into a Roth by going ahead and paying the taxes on that money today, you're supposed to wait 5 calendar years in order to touch that money. So for example, let's assume somebody did that on October 16th today of 2023. Their calendar year starts effectively January 1st of 2023. So we got 2023, 24, 25, 26, 27. So January 1st of 2028, hypothetically, you could touch that converted money prior to the age of 59 and a half, if that is applicable to you. So I like to make sure everybody knows about the three types of money inside of a Roth. That is an extra perk per se that is available inside of here. Now let's jump over to the IRA and Roth rules since we kind of skipped that at the beginning. In the event you pull money out prior to 59 and a half, there is a 10% penalty on those monies unless you qualify. This is just 5 common ways that you can access money prior to 59 and a half. It's not the end all or be all, but if you're using it for education expenses, or if you are changing employers and you need to pay your health insurance premiums between jobs, you can use your IRA monies for that and avoid a 10% penalty. If you want to use monies towards the first time down payment on a home, you can use up to $10,000 from that account effective 2023, assuming adjusted inflation for in the future. You've got disability. In the event you qualify for permanent disability, you can touch those monies prior to 59 and a half. Or if you wanted to take substantially equal periodic payments, that's a rabbit hole that we won't go down in this video, but more or less you can take that money out without penalty, without incurring that 10%, as long as you take that money out over installments over 5 years or longer. So again, we'll make another video on that to dive into it deeper. Now, if this money is IRA money, note you will owe taxes on that money. So you don't get to skip that tax that distribution rule on IRAs. Now, if it's a Roth, that makes things a little bit more easy, I guess we could say. Now, for the Roth, there are some special income limits. If you make too much money as a household or as a single individual, you will not be able to contribute to the Roth the old-fashioned way, the traditional way. You may have to incorporate a backdoor strategy where more or less you put some non-deductible contributions inside the IRA and then convert it the next business day. So you would have a 5-year calendar clock on those monies that you decide to convert, but there is ways to get money into the Roth if you fall outside of these income limits. Now, the traditional contribution limits for individuals as of 2023 are a little bit less than this, but 2024, they're going to be $7,000 if you're under the age of 50, or if you are 50 or older, you can actually contribute $8,000 per person. So that is the gist of how IRAs and Roths work. So let's figure out if a health savings account would be applicable in this situation. All right, so health savings accounts. So we're going to compare these to the Roth and the IRA for tax sake first. So if you want to recognize my bucket here, whenever you put money into a health savings account, now you have to have certain types of insurance coverage in order to qualify for one of these, which I'll get into here in just a moment. But whenever you're able to put money into this account, you get to knock that income off of or you get to deduct that dollar amount from your income as well. So that same situation I mentioned at the beginning of this video, husband and wife make $100,000 and collectively they put in $5,000 into HSAs for themselves. Their income would be adjusted downward for the calendar year that those contributions are for. Now, the best part about this is when the money comes out, it comes out tax-free. So like how a Roth distribution comes out tax-free, you're actually getting the best of both of these account types. You get a tax deduction on the money that goes in, and it gets to come out tax-free. Now, again, let me get into the qualifications of this. So for 2023, I've got the rules up here right now. You need $1,500 for self-only coverage or $3,000 if you have a family coverage plan as the minimum deductible that would qualify you for a health savings account, because you do have to have a high deductible health insurance plan. Now, there are some out-of-pocket expenses too that you need to take into consideration. So if your deductibles do meet these qualifications, but your out-of-pocket maximum family expense is higher than $7,500 for a single or $15,000 for a family plan, it would not necessarily qualify you to be able to utilize one of these tools. So the contribution limits for 2024, so we can compare those to the IRAs and Roths, we've got $4,150 for a single individual. A little difference on here is if you're the age of 55, you can add an extra catch-up contribution, which in this case is going to be about $1,000. For a family plan, you're looking at $8,300 for the family, and then an extra $1,000 for the families that have 55 and older included in them as well. So it's minor difference, 50 on IRAs and Roths, or it's 55 for catch-up contributions on HSAs. Now, this money gets to come out tax-free if it's for a qualifying medical expense. That's the catch with these. So here are some common qualified medical expenses. Again, this is not the end-all. I suggest you go to the IRS website to look at the long list of things that would qualify you, but here are some common ones that I thought were applicable to most people out there. So you've got allergy medication, you've got pain relievers like ibuprofen and aspirin. You can go to the dentist office, you can go to the eye doctor if you need a wheelchair, if you wanted any stop smoking programs, or a psychologist. You can take monies out of your HSA, again, tax-free, if you are using it for any of these qualifying medical expenses. Now, in the event you do not have any of these medical expenses, that's wonderful. That means you don't have any health problems, hopefully. You can take these monies out after the age of 65. And if you did that, think of your HSA turning into an IRA with taxation's sake. So these tax deductible contributions, as if they're not used for medical in the future, they would be taxed at 65 or later without any penalties or fees. Now, I'm going to hit the high note of the tax-free income. A lot of individuals like to leverage these types of accounts for their Medicare premiums in the future. So Medicare Part B, on average for 2024, the projected rate is supposed to be $175 a month per person. You could distribute monies to pay for that. Your Part D, so your prescription drug plans when you're 65 and older, or if you qualify due to a disability prior to that age. You could use it for your deductibles, your co-insurance. So I like to hit on these pretty hard because there is a lot of flexibility built into these. Another note I didn't put on here, or at least on the list, is you can roll over these monies year over year. Why that's relevant is because if you want to stack up all three of these buckets side by side, you can invest all three of these accounts equally. You could buy stocks or bonds or mutual funds in all three of them. So performance, take that out of the equation, they can all be equal. It's the taxation behind how you want your distributions to be distributed to you in the future is going to be the biggest point that I wanted to make with this short presentation. So this is a consolidated list. At the very bottom, I guess the whole point of this was to help you figure out which is going to be best. There is no single answer, but I know that's not everybody's request inside of one of these videos, but these are the factors you need to really take into consideration, whether you're talking with your financial advisor or you're a tax professional or even attorney, whomever it is that you work with on these finances. I would say you definitely want to take into consideration your current tax bracket. If you're in the highest income tax bracket, it might make sense to use an IRA versus a Roth for your situation. Or if you're in a lower tax bracket from what you perceive tax rates to be in the future, we don't have the crystal ball to know. But if we wanted to prepare for all scenarios, you might take into consideration investing into a combination of these three. But your beliefs on what you think future tax brackets are going to be is another relevant fact you want to take into consideration. Your disposable incomes, how much you actually could save collectively between the accounts. Your current health insurance plan is going to be applicable to the HSA and if you could qualify for it in the first place. Your current health status is going to matter too. So even if you do have a good health insurance plan that offers an HSA qualified plan, it may not make sense for you because you may have some medical conditions that are going to make you meet that deductible sooner, that higher deductible that you're signing up for. And then lastly, your financial goals. So based on your retirement goals, that's what I define as the day that you are financially free, that you don't have to go punch the clock for somebody or have a responsibility to make your paycheck happen. That is going to be a big part and factor in determining which of these account types is going to be applicable to you as well. So I strongly suggest getting in touch with a financial advisor, a tax professional, or whomever it is that can help you with these concepts. In the event you would like us to help you out, or if you wanted a non-biased opinion on these matters, we're happy to help at Stack Enterprises. Our contact information is below in this video description. So thank you for your time today. I hope you enjoyed this. Also, please leave any comments of any other subjects that you'd like for me to go a little bit more in depth on, and give me some feedback on if you like this style of video, if I had more or less an infinite whiteboard where I can go up and down and kind of slide through some pictures that I put together. So that was all. Again, thank you. Have a great day. Look forward to talking to you soon.